Largest metals desk shuts down as prices surge to $52. Have you ever felt the ground shift beneath your feet? Not a gentle tremor, but a violent, earth-shattering lurch that changes your perception of solid ground forever. In the financial world, we just experienced such a quake. It didn't register on any seismograph, but it sent shockwaves through every trading terminal, every bank vault, and every investor's heart across the globe. We are witnessing the spectacular, explosive revaluation of silver, an asset that has been dormant, manipulated, and misunderstood for decades. Today, the price didn't just climb. It detonated, surging past a nominal $52 an ounce in a breathtaking display of market force. This is not just another rally. This is a rebellion. It is a fundamental repricing of reality, a violent rejection of the paper promises that have governed the world's financial architecture for half a century. What you are hearing in the market's roar is the sound of chains breaking. The core problem, the deep, festering wound in the precious metals market, has always been the profound disconnect between the physical reality of the metal and the ethereal world of paper derivatives that pretended to represent it. For decades, institutions in London and New York built a towering edifice of futures contracts, unallocated accounts, and exchange-traded funds, all balanced precariously on a tiny sliver of actual physical silver. This system allowed for immense leverage, enabling traders to control vast amounts of notional silver with very little capital. It created an environment where the price was not discovered by the interplay of real supply and demand from miners and users, but was instead dictated by the speculative whims and immense financial power of a few large commercial banks, often incentivized to keep prices suppressed to benefit their complex derivatives books. This was a system of control, not of commerce, and like all such artificial constructs, it was inherently fragile, waiting for a catalyst powerful enough to expose its hollow core. The catalyst arrived today not with a whisper, but with a deafening bang. News broke that ripped through the market with the force of a thunderclap. North America's largest, most integral precious metals trading desk, a veritable cornerstone of the bullion market, had ceased operations. StoneX, the behemoth through which a vast portion of physical and paper metals flow, simply shut down. The official reason given was overwhelming order volumes, but that is a polite euphemism for a much more terrifying reality. It means the system broke. It means the flood of buy orders was so immense, so relentless, that the desk could no longer function. They could not find the physical metal to hedge their positions, they could not manage the cataclysmic risk of a price moving parabolically, and they made the only decision they could to survive. They pulled the plug. This single act was the spark that lit the tinderbox, signaling to the entire world that the paper emperor had no clothes. This was the tipping point, the moment the paradigm shifted irreversibly. The shutdown of a central trading hub like StoneX is not a minor glitch. It is a systemic event. It is the financial equivalent of the main water valve for a city bursting. Suddenly, the illusion of liquidity vanished. The belief that you could always buy or sell, the very foundation of a functioning market, was shattered. This failure sent a wave of panic cascading through the system. If the largest desk can't operate, who can? This immediately triggered a frantic worldwide scramble for physical bullion. It was no longer about making a profit. It was about securing tangible assets in a system that was visibly failing. The tipping point is reached when fear replaces greed as the dominant driver of market behavior, and the StoneX shutdown was a fear-inducing event of the highest magnitude, transforming a rally into a full-blown panic-driven short squeeze. The immediate impact was a magnificent and terrifying spectacle of price discovery in its most raw form. Silver's ascent was vertical, blowing past technical resistance levels as if they were imaginary lines on a chart, which in the face of a physical shortage they were. The 4.4% surge was just the headline. The real story was in the underlying market structure's disintegration. Premiums on physical products like coins and bars exploded, creating a massive chasm between the spot price on a screen and the actual price to acquire metal in your hand. Dealers like the mentioned commercial rare coins were forced to suspend sales entirely. They were caught in an impossible situation. They couldn't source new inventory, they couldn't hedge their existing stock in a non-functioning market, and they couldn't determine a fair price when the market was moving by dollars every hour. This is the anatomy of a market failure, where commerce simply stops, leaving investors and industries stranded. The critical lesson from this cataclysm is the brutal, undeniable primacy of physical reality over financial abstraction. For years, we were told that paper and physical were interchangeable, that a contract was as good as the coin. Today, that fiction was incinerated. The true value of silver is not the number on a screen determined by leveraged bets. It is the value of a finite, tangible asset with thousands of years of monetary history and indispensable industrial applications. The takeaway is that in times of crisis, possession is everything. The system of paper promises, of rehypothecation of unallocated accounts, has been exposed as a fragile house of cards. The new era will be defined by a return to fundamentals, verifiable physical assets that cannot be printed into existence or defaulted upon. This is not just a repricing of silver. It is the beginning of a repricing of all assets and a profound lesson in the true meaning of wealth. 7. Let us delve deeper into the structural fragility that made this day inevitable. The global silver market has long been a tale of two cities: London, the center for large wholesale bars and unallocated accounts, and New York, the home of the StoneX futures exchange. The London Bullion Market Association, or LBMA, operates on a system of trust among a small club of large banks. Much of the silver traded there is unallocated, meaning clients have a claim on a pool of silver but not specific segregated bars. This system is efficient for settlement between members, but creates a massive amount of paper claims on a limited supply of physical metal. It is, in essence, a fractional reserve system for silver. For decades, this has worked, allowing for the smooth functioning of the market, and critics would argue, providing the mechanism for large banks to issue paper claims far in excess of the physical metal they held, thereby suppressing the price. On the other side of the Atlantic, the StoneX in New York operates as the primary hedging and speculative venue. It deals in futures contracts, which are agreements to buy or sell silver at a future date for a predetermined price. The vast majority, over 99%, of these contracts are settled in cash before delivery. They are betting instruments. However, every contract carries the legal right to demand physical delivery of 5 1,000-ounce silver bars. This delivery mechanism is the crucial link, the backstop that is supposed to keep the paper price tethered to physical reality. If the futures price gets too low relative to the physical price, traders are supposed to buy contracts, take delivery, and sell the metal for a profit. But what happens when the amount of paper claims eligible for delivery dwarfs the available inventory in the exchange's warehouses? This is the question the market has been terrified to ask, and today, it demanded an answer. The answer came in the form of a historic short squeeze. A squeeze occurs when a large number of participants are short the market, meaning they have sold contracts they do not own, betting on a price decline. To close their position, they must buy back those contracts. If a powerful catalyst drives the price sharply higher, these short sellers are forced to buy back at ever-increasing prices to avoid catastrophic losses from margin calls. This forced buying creates a vicious feedback loop, a buying panic that feeds on itself. In the silver market, the shorts have historically been a handful of large commercial banks, who for years profited by keeping the price contained. But today, they faced a new opponent: a global decentralized army of investors, institutions, and even industrial users who were all demanding physical metal at the same time. The banks had sold promises of silver that they could not keep. The situation was supercharged by an anomaly in the global price structure: the London premium. As reported, the price of silver in London had soared to an unprecedented level over the New York price. This is a glaring red flag indicating a severe physical shortage in the London market, the supposed heart of global wholesale bullion. Traders were reportedly booking cargo slots on transatlantic flights to ship silver from New York to London to capture this arbitrage, a desperate and expensive measure typically reserved for gold. This indicates the normal shipping and settlement channels were overwhelmed. The engine of the global silver market was seizing. The surging lease rates, the cost to borrow physical silver, confirmed this. A lease rate of over 30% is not a commercial rate. It is a default rate. It screams that there is no physical metal available to be borrowed to deliver against short positions. It was the final nail in the coffin for the short sellers. Now, consider the psychological impact of the StoneX shutdown spreading through the intricate web of the global financial system. StoneX is not just a dealer, it is a core-clearing member and market maker. They provide liquidity and services to a vast network of smaller dealers, mints, industrial users, and investment funds. When they go dark, the entire supply chain fractures. A smaller coin dealer who hedges their inventory through StoneX is now flying blind, exposed to massive risk. An industrial company that needs to secure 1 million ounces of silver for their manufacturing process suddenly finds their primary supplier is offline. An investment fund looking to allocate capital into physical metal finds the main gateway closed. The shutdown creates a crisis of confidence that radiates outwards, causing other market participants to pull back, hoard inventory, and stop trading, further exacerbating the liquidity crisis and the price spike. This brings us to the retail level, a microcosm of the institutional panic. The decision by a reputable dealer like Brian Kuzmer to suspend all silver sales is a profoundly significant event. He has never done this before, not even during the chaotic spike to $50 in 1980. His reasons are a perfect summary of a market in complete disarray. He cannot hedge his risk, he cannot find new products to sell, and he cannot determine what premium to charge. The premium, the amount over the spot price a dealer charges, is based on supply, demand, and replacement cost. In a market where the spot price is a fiction and replacement is impossible, the premium becomes infinite. The dealer's sage advice, "Don't sell," is a rational response to an irrational market. It signals a shift from treating silver as a commodity to be traded to viewing it as a life raft to be held in the midst of a currency storm. Let us now broaden our lens to the other precious metals, for this is not a story confined to silver. Gold, the undisputed king of monetary metals, has also rocketed higher, breaking the psychologically significant $4,000 level and then some, climbing to over $4,100 an ounce. This is not a coincidence. Gold and silver are inextricably linked in the minds of investors as monetary havens. The crisis in the silver market serves as a stark warning about the fragility of all paper commodity markets. Sophisticated investors understand that the same fractional reserve games played in silver have also been played in the gold market, perhaps on an even grander scale. The run on physical silver is a shot across the bow, prompting a preemptive move into physical gold before that market, which is larger but still finite, suffers the same fate. And what of the platinum group metals, or PGMs? Palladium's stunning 5.5% surge and platinum's solid 2% gain demonstrate that this is a broad-based flight to tangible assets. These metals are primarily industrial, with critical applications in catalytic converters for automobiles, but they also have a history as monetary assets and stores of value. The fears that are driving the silver squeeze, supply chain disruptions, currency debasement, and a breakdown in trust in paper markets, apply to them as well. The mention of the Section 232 probe into critical minerals, which includes silver, platinum, and palladium, adds another layer of geopolitical risk. The threat of tariffs or other trade barriers acts as an accelerant, exacerbating fears of physical shortages and prompting industrial users and investors alike to secure their supply chains before governments can interfere with them. To truly appreciate the magnitude of what is happening, we must place it in its proper historical context. The comparison to the 1980 silver spike orchestrated by the Hunt brothers is both useful and misleading. The Hunts attempted to corner the market by using massive leverage in the futures market. They were ultimately defeated when the exchange, with the backing of the Federal Reserve, changed the rules mid-game to liquidation only, forcing them to sell and crushing the price. Today's situation is fundamentally different. This is not the work of a few leveraged speculators. This is a decentralized, grassroots movement of millions of global investors who have lost faith in the solvency of the unbacked paper currency system. They are not using extreme leverage, they are demanding physical delivery. They are taking the metal off the exchanges and out of the system. You cannot defeat this kind of movement by changing the rules of a paper game they are no longer playing. A more recent and perhaps more accurate parallel is the London Metal Exchange's nickel crisis of 2022. A massive short position held by a single Chinese tycoon, combined with supply fears following the conflict in Ukraine, caused the price of nickel to more than double in a matter of hours. The LME, facing the insolvency of multiple clearing members, took the unprecedented step of halting trading and retroactively canceling billions of dollars worth of legitimate trades. This act destroyed the LME's credibility as a reliable market. It proved that when the chips were down, the exchange would protect its members at the expense of its clients and the principles of free markets. The shutdown of the StoneX desk is this event's cousin. It is another major institution admitting the market is broken and that it cannot function under conditions of extreme stress. Every time this happens, more faith is drained from the paper system and flows into the physical. Let us now turn our attention to the future and attempt to predict the trajectory of this crisis. The first and most immediate consequence will be the permanent bifurcation of the silver price. The spot price quoted on financial television and websites will become increasingly irrelevant, a ghost price from a defunct system. Instead, the market will be defined by a series of physical prices: the price for a 1,000-ounce wholesale bar, the price for a 100-ounce bar, the price for a 1-ounce sovereign coin. Each will carry a different and wildly fluctuating premium based on its availability, portability, and recognizability. The spread between the paper futures price and the price to get physical metal in your hand will widen from dollars to tens of dollars, and possibly more. This will create chaos for industries that rely on the spot price for hedging and contracts, effectively forcing a complete overhaul of how industrial silver is bought and sold. The second-order effect will be a full-blown panic in industrial supply chains. Silver is not a pet rock. It is a critical input for the 21st century economy. It is the key ingredient in solar panels, a vital component in every electric vehicle, smartphone, and computer motherboard. The procurement managers at companies like Apple, Samsung, Tesla, and First Solar are not financial speculators. They need to source millions of ounces of physical silver on a predictable basis to keep their production lines running. They are now facing a nightmare scenario: a parabolic price spike combined with a complete evaporation of available physical supply. They will be forced to enter the market at any price to secure the metal they need, becoming another massive source of buying pressure and further fueling the short squeeze. We could see production halts in key technology sectors as a direct result of this silver crisis. The crisis will inevitably spread like a contagion to the gold market. The capital that was seeking a home in silver will, upon finding that market broken and physical metal unobtainable, immediately pivot to the next best monetary asset: gold. The run on physical gold will be even more intense, as the pool of potential buyers, including sovereign wealth funds and central banks, is vastly larger. The same dynamics will play out. Premiums will explode, dealers will sell out, and the disconnect between the paper price and the physical price will become a chasm. Gold's move to over $4,100 is just the opening act. We are likely to see a rapid revaluation that will push the price towards $5,000 and beyond as the market comes to terms with the fact that the emperor of paper money has no clothes. This will force a reaction from regulators and central banks, but their options will be limited and likely counterproductive. The Commodity Futures Trading Commission, or CFTC, will launch an investigation. The COMEX and LBMA may institute trading halts or position limits. They may even, in a repeat of 1980, change the rules to force the liquidation of long positions. However, such actions will only serve to confirm the market's worst fears: that the game is rigged. Forcing investors to sell their claims for devaluing paper dollars, when what they want is the real metal, will shatter the last vestiges of trust in these institutions. It will be seen not as a regulatory action, but as an officially sanctioned default. They cannot print physical silver, and any attempt to use the force of regulation to solve a problem of physical scarcity is doomed to fail and will only accelerate the exodus from the paper markets. We are witnessing the early stages of the remonetization of silver. For the last century, silver has been systematically demonetized, removed from coinage and pushed to the periphery of the financial system, treated as a mere industrial commodity. This was an historical anomaly. For 5,000 years prior, silver was money, a store of value and a medium of exchange for the common person. This crisis is forcing the world to rediscover silver's monetary nature. As faith in fiat currencies wanes and trust in financial institutions evaporates, people will naturally gravitate towards assets that have intrinsic value and no counterparty risk. Silver, due to its history, its physical properties, and its relative affordability compared to gold, is perfectly positioned to fill this role. We are not just seeing a price spike, we are seeing a paradigm shift in how the world perceives and values silver. Looking further into the future, the ultimate outcome of this crisis could be a forced reset of the global financial system. The massive short positions in the paper silver market are held by institutions that are considered too big to fail. A default on their silver obligations could trigger a chain reaction of insolvencies throughout the banking system, similar to the collapse of Lehman Brothers in 2008, which was triggered by defaults in the mortgage market. The derivatives books of these major banks are a tangled, opaque mess. A blow-up in the precious metals sector could be the black swan event that reveals the entire system is bankrupt. This would force a global monetary conference, a new Bretton Woods, where the world's leaders would have to construct a new system, likely one in which hard assets like gold and possibly silver play a formal, anchoring role. The geopolitical implications are immense. The ongoing tensions between the United States and China are a significant backdrop to this rally. China is a massive producer and consumer of all commodities, including precious metals. The trade wars and tariff threats have highlighted the fragility of global supply chains and have accelerated a trend of de-dollarization among Eastern nations. China and Russia have been steadily accumulating massive gold reserves for years. A crisis in the Western-dominated paper metals markets would be a golden opportunity for them to challenge the dominance of the dollar and the Western financial system. They could, for instance, back their own currencies with gold, a move that would dramatically accelerate the decline of the dollar as the world's primary reserve currency. The silver squeeze is not just a market event, it is a battle in a new great power competition. Let's consider the role of technology in this modern-day bank run on the commodity exchanges. The decentralized nature of the buying panic is a feature of the Internet age. Information, or what is perceived as such, spreads across the globe in an instant through social media platforms. Movements can coalesce and organize without any central leadership, as we have seen in other meme stock phenomena. While some may dismiss this as unsophisticated retail speculation, they are missing the point. It represents a widespread and deeply felt loss of trust in established institutions, from governments and central banks to the mainstream financial media. This is a populist financial rebellion, and its participants are not trying to scalp a few points in the futures market. They are trying to exchange their rapidly devaluing paper currency for real, tangible wealth. This makes their conviction to buy and hold far stronger than that of a traditional speculator. The crisis will also shine a harsh spotlight on the practices of the bullion banking industry and the institutions that are supposed to regulate them. The evidence of price manipulation in the silver market, through the practice of spoofing and the coordinated use of massive short positions, has been accumulating for years, leading to multiple fines and even criminal convictions. However, these have always been treated as the actions of a few rogue traders. This market-breaking squeeze will expose the manipulation not as an aberration, but as a core feature of the pricing mechanism. The resulting loss of public trust will be profound and permanent. It will lead to calls for a complete overhaul of these markets, perhaps even their replacement with new, more transparent systems based on blockchain technology that can provide a verifiable audit trail for every ounce of metal. What does this mean for the average person, the investor who has been patiently accumulating physical silver and gold for years? First, it is a moment of profound vindication. The core thesis of the hard money advocate, that the fiat currency and fractional reserve banking system is inherently unstable and destined to fail, is being proven correct in the most dramatic fashion imaginable. Second, it presents a difficult choice. The temptation to sell and realize life-changing nominal gains will be immense. However, the question must be asked, what do you sell it for? Do you exchange your real, physical wealth for the very paper currencies that are collapsing in value and whose failure is the reason for the price spike in the first place? For many, the answer will be no. They are not holding silver to get more dollars. They are holding silver to preserve their wealth through the death of the dollar system. The aftermath of this event will be a new financial landscape. The era of financialization, where the value of paper derivatives could balloon to hundreds of times the value of the underlying physical asset, will be over, at least in the commodities space. Price discovery will return to the physical markets. The value of an asset will be determined not by how many leveraged bets can be placed upon it, but by its genuine utility and scarcity. This will be a painful transition. It will bankrupt institutions that are on the wrong side of the trade and cause immense disruption to industries that have grown accustomed to the artificially stable and suppressed prices of the old regime. But it is a necessary transition, a cleansing fire that will purge the system of its excesses and lay the groundwork for a more stable and honest financial order. We must also contemplate the societal impact. A rapid and dramatic revaluation of money affects everyone. It wipes out the savings of those who held their wealth in cash and fixed income assets. It punishes prudence and rewards speculation. It can lead to social and political instability as the cost of living skyrockets, and the gap between the haves and the have-nots widens into an unbridgeable chasm. The soaring prices of gold and silver are a symptom of a deep sickness in our monetary system. While those who hold the metals will be protected, it is crucial to recognize that this is a tragedy for society as a whole. It is the inevitable and painful consequence of decades of fiscal irresponsibility and monetary malpractice by governments and central banks around the world. In conclusion, the explosion in the silver price to over $52 and the shutdown of a major trading desk is not just a news story. It is a landmark event, a historical inflection point. It marks the moment when the long-running conflict between the paper and physical markets finally broke out into open warfare. It signals the failure of the price suppression scheme and the beginning of a true price discovery process for one of the world's most critical monetary and industrial metals. The consequences will be far-reaching and profound, impacting everything from industrial supply chains and geopolitical alignments to the very structure of the global monetary system. We are in uncharted territory, but the lesson is clear. In a world of infinite paper promises, the finite, the tangible, and the real are king. The final takeaway is a call to intellectual arms. This is the time to educate yourself, to understand the history of money, and to think critically about the nature of our financial system. The events unfolding are complex, but the underlying principles are simple. Wealth is not the same as currency. A promise to pay is not payment. Counterparty risk is real. The crisis in the silver market is a wake-up call for everyone. It is a warning that the system we have all taken for granted is far more fragile than we believed. The future will belong to those who understand this, who position themselves accordingly, and who appreciate the enduring value of assets that have stood the test of time. What we are seeing is not the end of the world, but it is the end of a world and the birth of a new one.